If you're looking for the deepest analysis of the corporate drama shaking up Hollywood right now, you have definitely come to the right place. We are diving into the, staggering multi-billion-dollar battle for Warner Bros. Discovery, WBD. And this isn't just another merger, it's a fight for the future of entertainment, and the price tag has already blown past $77 billion.
It's incredible. For weeks, it felt like we were just watching the inevitable happen. Netflix, the streaming giant, was making this very surgical strike to acquire the studio and streaming assets from WBD.
Right. And that initial agreement, what was it, $72 billion? It looked like it was going to create this, unassailable media powerhouse overnight.
Everyone thought the deal was done. The negotiating was over.
And that's when the bomb dropped.
Oh, yeah. Just as everyone was, getting ready for the regulatory review, Paramount Skydance PSKY just comes flying in with a hostile takeover bid.
And this wasn't some quiet proposal. This was loud. It was public.
It was an all-cash offer for the entire company. It just threw the whole thing into absolute chaos.
Okay, let's unpack this, because to really get the fight here, you have to understand the two very different things being purchased. Netflix's offer and Paramount's offer,
Yeah.
they're buying fundamentally different assets.
That is the absolute crux of all the confusion. The original deal, the one negotiated between WBD and Netflix, was extremely targeted.
They weren't trying to buy the whole company.
No, not at all. They were buying the high-value, the future-facing parts. So that meant WBD's huge film intelligence studios, all that foundational IP, and crucially, HBO and HBO Max.
We're talking about the crown jewels of content. Everything Netflix needs to feed its massive global subscriber base.
Precisely. And that $72 billion deal came out to about $27.75 per share. It was a mix, part cash, part Netflix stock, a very strategic, content-focused move.
But the real key is what they didn't want, what they excluded.
Right. The deal left behind WBD's entire sprawling traditional cable network division. Things CNN, TNT, TBS, the Food Network, Cartoon Network. The list goes on.
Assets that, frankly, WBD leadership has been trying to shed for a while now.
Exactly. Their strategy was always to spin those cable channels off into their own company. Let the new, slimmed-down studio operation focus just on high-growth digital content.
So the Netflix offer was really enabling WBD's pre-existing plan. It helped them cleanse their balance sheet of those legacy assets.
Yes, and that is exactly where Paramount Skydance saw its opening. They just completely sidestepped the WBD board, which had already approved the Netflix offer, and they went straight to the shareholders.
A really raw and aggressive strategy. So how did they structure their counteroffer to appeal directly to those shareholders?
It was brutally simple.
Mm.
Higher price, all cash, and buy everything. Paramount offered an all-cash bid of $77.9 billion. That's $30 per share. And that was for the entire company. Studios, streaming, and all those legacy cable channels Netflix didn't want.
So their public argument was basically, why bother with a complicated deal?
Yeah, why take a deal with stock and the uncertainty of some future spin-off when you can just take more cash right now for everything?
Mm.
They literally called their bid a superior alternative, based purely on that higher immediate per share number.
Okay, and that sets the stage for the big financial battle, which is, I think for most people watching, incredibly confusing. Paramount is out there saying its deal gives shareholders $18 billion more in cash. We have to clear this up, because why would WBD's board ever accept a lower offer?
That financial claim is absolutely the murkiest part, and it all hinges on the fact that you just aren't comparing apples to apples. You're comparing like a really great part of an apple to the whole apple, including the bruised parts that are starting to go bad.
So the $30 a share from Paramount is for the whole thing.
The whole thing, including the cable networks that WBD was actively trying to get rid of. Netflix's $27.75 per share was only for the most valuable assets, the content engines.
Let's try an analogy here to make this really clear for you. Imagine you own a massive property. You've got a gleaming, super profitable office tower. That's HBO and the studios. But you've also got like a dozen old, debt-ridden warehouses that cost a fortune to maintain. That's the cable division.
Right. So Netflix comes in and says, we'll buy your shiny office tower for $27.75 a square foot.
Yeah.
And you can keep the warehouses, and you can sell them off later.
Oh, okay.
So the WBD board looked at that and said, look, if we sell the tower now, and then we spin off and sell the warehouses,
Yeah.
even at a discount,
Yeah.
the total value we get for our shareholders could easily be, $31 or $32 per share overall.
So the partial sale actually offers a greater total return in their eyes.
Potentially, yes. It lets them monetize the valuable stuff immediately and then jettison the less valuable assets in a separate deal. It frees them from all the debt and operating costs of those networks.
Oh.
The board basically believed the combined value, the sale plus the spinoff, would be more than Paramount's straight cash bid.
It's a classic gamble on future potential versus cash in hand right now. But you have to admit, the financial muscle behind Paramount Skydance's bid is serious. They are not messing around here.
Oh, it's impressive. The financing is designed to show shareholders that this $77.9 billion is very, very real. It's not just the Ellison family's wealth. You have Redbird Capital, a huge private equity firm, and then debt commitments from Citi, Bank of America, Apollo.
The heavy hitters.
The heaviest. It signals to the WBD board this is not a bluff. They have the capital locked in to close this deal.
And that leads us right into the potential for a bidding war, which, from Netflix's point of view, has to be the worst-case scenario.
It's the worst of both worlds for them, yeah. They spent all this time negotiating what they thought was a good deal, and now they could just lose the prize altogether.
Pay a lot more for it.
Or pay a lot more. The immediate result of the hostile bid was that WBD's stock price just surged. The market is now pricing in a bidding war. So if Netflix still wants to win, they have to pay more, potentially way more than their internal valuation.
Which begs the question, how badly does Netflix really want HBO? Are they just going to open the checkbook and try to out-leverage David Ellison?
I don't think so. I think you have to look at Netflix's real strategic advantage here. And it isn't money, it's data. I mean, for 2 decades, they've been building the industry's best recommendation engine. They have this massive treasure trove of data on what people watch.
They know what keeps people subscribed.
They know exactly what keeps people subscribed, so they can calculate the precise ROI of buying the entire HBO library with way more accuracy than anyone else. They know mathematically what that content is worth to them. So they have a ceiling, a hard ceiling. They're very unlikely to overpay just to win a fight. They'll bid based on their data, and if the price goes higher, I think they might just walk away.
That is a fascinating constraint. So one side has more cash, but the other has the more precise valuation model. But let's say they figure out the money. They still have to face the ultimate gatekeepers, the regulators.
And the regulatory hurdle is where both sides are playing this high-stakes game of, lies, damned lies, and statistics.
They're both trying to shape the narrative.
Completely. Both Paramount and Netflix are trying to convince the government that their deal is the one that's good for competition. And to do that, they're using totally different measuring sticks to define what the market even is.
Okay, so what's Paramount's angle? How are they arguing the Netflix deal is anti-competitive?
David Ellison's been very public about this. He frames it using the simplest metric, streaming subscriber rank. His argument is that letting the #1 streaming service, Netflix, combined with the #3 HBO, well, that creates a digital monopoly, or something very close to it.
It's a very easy argument for the public to understand.
It is. But Netflix is countering with a completely different definition of the media market. They're saying, don't look at our subscriber list. Look at how much time consumers spend with us compared to everyone else.
And they're using third-party data for this.
Yeah, they're leaning on data from Nielsen, which measures total consumer viewing time across everything. Broadcast, cable, streaming, all of it. And when you use that metric, Netflix's position looks a lot less dominant.
How much less?
Well, in terms of total TV viewing time, Netflix is actually 6th on the list. They control about 8% of the total time watched. They're way behind giants like Alphabet's YouTube, which is #1, and Disney at #2.
And this is where the comparison gets really powerful, right? Because where does Paramount sit on that same list?
Right next to them. Paramount itself controls about 8.2% of total TV viewing time. It's fractionally more than Netflix. So their argument is, if Netflix buying HBO is anti-competitive, then Paramount is already just as dominant by that very same metric.
This raises an important question, then.
It's the question. Regulators have to decide which metric more accurately reflects reality. Is the market just subscription streaming services where Netflix is the undisputed king? Or is it the total universe of consumer viewing time, which includes everything?
And that single decision changes everything. If they go with total viewing time, it opens the door for mergers that would have been unthinkable before.
Absolutely. And that strategic game convincing regulators to pick your favorite definition is arguably more important than the final price tag.
We also have to remember, while all this is going on, there are huge immediate costs if these deals just fall apart. the breakup fees.
And they are substantial.
Mm.
I mean, the stakes are just astronomical. On the Netflix side, if they walk away, maybe the price gets too high or regulators just kill the deal. Netflix owes WBD a $5.8 billion breakup fee.
5.8 billion, that's a huge penalty.
It's designed to ensure they're serious. But on the other side, if WBD's board violates the agreement, let's say they suddenly recommend the Paramount bid instead, WBD would owe Netflix $2.8 billion.
So that fee is a major deterrent. It makes the board think twice before just chasing a slightly higher cash offer.
It's a game of chicken where even losing costs you billions. This whole saga just perfectly illustrates how deal structure and regulatory strategy combine to decide the fate of these giants.
The partial sale versus the full cash acquisition.
Exactly. The key takeaway for you listening is that WBD's board still might believe that the strategic value of shedding its cable business makes Netflix's offer the superior long-term play, despite the lower share price. Paramount's entire challenge is to force them to abandon that strategy for the certainty of immediate cash.
And this drama is far, far from over. No matter who wins this bidding war, the final marriage still needs that critical regulatory approval.
And that's the true test. The real question is which definition the federal regulators will ultimately adopt. If they define the market by streaming rank, Netflix HBO looks like a potential monopoly. But if they prioritize total consumer viewing time, where Netflix is sixth, it just looks like healthy competition.
So you should think about how a single, almost academic definition, chosen by an administrative body, could fundamentally restructure the entire global entertainment industry. It affects everything you watch, everything you subscribe to, and everything you pay for over the next 10 years.
That one regulatory decision could carry more weight than all $77 billion combined.
We'll keep watching this story unfold. We'll catch you on the next deep dive.